What happens when you have way too much money chasing way too few goods? Well, inflation. Okay, that's what causes inflation. But here's what a lot of people don't understand. That inflation doesn't go away. It just keeps compounding on itself. So if you went from 2015, you added all this inflation and you compound it, it equates out to our inflation is up 35% since 2015. So that means your dollar is worth less. Now, let me go over here and I'll explain to you how this really matters for interest rates. Okay, so here's what's going on with interest rates. Okay, so what you normally have is right through here, you have the annual inflation numbers. Okay, the 10-year treasury is, think of a bond. You want to invest in a bond, and that's this chart that we watch through here. This is telling us what the price of the bond is doing. Okay, so if you go over to here, this is saying, okay, inflation is in the red. Okay, but what bond investors have to do, they have to say, okay, inflation is deteriorating our dollar, and if we want to invest in something, at least to have security in our money, let's go into maybe a 10-year treasury, something really safe that kind of monitors inflation, but we want a margin there. So if inflation's at 2%, what it normally is, as a treasury buyer, I'm okay with a 3% yield. I got a 1% return on all that money. So that's what they usually have, a 1 or 2% cushion. Well, you can see this over time. It usually plays out pretty well, and sometimes it doesn't work out, and sometimes it really doesn't work out. So now, right now, the bond market's kind of playing catch up. So what the bond market's saying now is, where's inflation? What's it at? Is it 6? Is it at 2? Is it at 3? Is it at 8? So then they're going to use the numbers accordingly to figure out where bond yields go.